Hello, everybody. Nice to see you guys. Let me just. I hope everyone is doing fine. If you can hear me well, do let me know that you can hear me okay. I'll just set up the meeting for a while. And if you have just joined us, thank you very much. My name is Stanley, and you can always, from your Zoom, if you're joining us on Zoom, you can click on the chat box up, and we can always have a chat at any point. If you want to ask a question, let me know on the chat box. I'll check it as and when we have a short break or when we come to the end of the presentation. Let me get the slides back up. There you go. And thank you so much for joining me today. And today we're going to talk about one very, very important topic, which is really not talked about a lot, which is some of the key things that we have to do before we even start investing. Because I know that if when we first get started in investing, it is always an exciting endeavor, and it's also a very, can be a little bit of scary, but also full of excitement to buy our first stock or start investing. But there are actually a few key things that I think we should be focusing on first before we even start our brokerage account. So let's take a look into that. And of course, as our usual disclaimer, today's presentation is mainly for educational and information purposes, right? Please don't treat any of it as investment advice, and please do your own research before buying any investment. Okay, if you are new to me, I would just like to do a short introduction, which is my name is Stanley, and I generally share information through my YouTube channel called Learn with Stanley, and also through our website called valueinvestasia.com. And if you need to find and reach out to me in any way through our official social media channel, all the official channel that I have will be listed on learnwithstanley.com, right? And as a disclaimer as well, I just want to let you guys know as well that I am this year, I joined iFast Global Market as a wealth manager. So that will be also a key part of my job going forward as well. But that is just for your information at the moment. And of course, I do a lot of sharing mainly on YouTube and also from my website, but also I do in this webinar is a kind of model after what I have been doing regularly for my Premium Club members, and where we go into much more detail, sometimes into specific sector and specific stocks, and I would run through key analysis for them to let them have more information about things that they are focusing on, because some of the webinars for my members are actually voted by them. So they vote what kind of topic that they want to focus on, and I'll do the research for them and then present it for them. Okay, and today we're gonna focus more on key things to do before investing. But instead of doing it like a list of things that you should do, I'd just like to share with you guys some small stories, right? Few key stories, mainly three, and from them, try and relate to why that is important and what are some of the key things that we should be focusing on before investing, and how to create the ideal portfolio process for us, investing process for us, so that it can be sustainable and we can do it for long term. Because investing, is not just about picking one stock and hopefully it works. It's about a systematic way of how we should save and let our money grow in the stock market over decades. Sometimes if you're investing for retirement or you're investing for your kids' education is more, the time frame should be in years ahead. So we should have a game plan per se of how we should be able to operate that for a long period of time, and we can continue that. Okay. And the first story I want to share with you guys is actually about a janitor. And this janitor in the US, he actually built a 8 million fortune by the time he passed, and without anybody knowing. And this makes news because in our society, we often relate being a millionaire or being rich or being wealthy as what the person portray on the outside, right? If they drive a nice car or they have a nice house, or they're willing to, the way they spend money. But actually, the way they spend money has nothing to do with how wealthy the person can be, right? And this is a perfect example that a janitor that continue his work up to he the end of his career, still as a janitor, but with that humble job, he's able to build up a 8 million fortune. And nobody around him know, because he was never one that showcase his wealth, and he didn't spend that money, and that's why he ended up having such a big wealth pile at the end. And so the key thing here is actually to realize that to grow our wealth, the first part is not investing. The first part is not what stock to buy to become wealthy in the future. The first part is actually how to start saving money. And it is only by this simple act of understanding that our income is more should be more than our expenses, and we have surplus every month or every quarter, and over a long period of time, that is the key part of building wealth. That is the first layer of brick to build in this journey of building wealth. So a key exercise for us maybe is to just break it down and understand where's our income coming from and where's our expenses going out. It can be, nowadays with a lot of online payments and just cashless payment, it is much easier to track our expenses. Our income is not too hard to check. From our salary, from our, maybe if you have property or rental income, from our dividend income, all this is quite easy to track. But our expenses sometimes is very hard to track. But now if you spend more and more, a percentage of your expenses using cashless payment, then you will tend to have a record now. And I will encourage you to just break it down and see, on a month-to-month basis, and track for a few months to see where is your average expenses on, and how does that compare with your income. And when you find that relationship, try to make sure there's an excess. And if there is not, then look at both sides on how we can grow your income more, or how you can reduce your expenses, so that you have a consistent monthly excess from there. And then that will be the foundation to start building your wealth, and put that money into maybe a separate account. And even if you don't know where to keep it in a cash management account. I just have a screenshot right here, which is from our iFast platform, that some of the key interest rate that they give on a daily basis. Of course, this percentage is on per annum, but the interest is calculated on a daily basis, and there's no lock-in. And these are some of the options that before you start investing, just park the money somewhere to ensure that they're earning some interest, but to ensure that you have that consistent excess saving every single month. Next is the story of Toys R Us, right? And of course, we know now that Toys R Us has gone bankrupt, and it has restructured actually. And but why did the company fall into that situation in the first place? Why does a company go bankrupt in the first place? And a company that fall into Chapter 11, like bankruptcy protection, typically is not because not only because that maybe they have declining revenue or the business is not doing well. But the point where it reached the trigger point of going into bankruptcy is always due to unable ability to fulfill their debt obligation. And Toys R Us, when they went bankrupt, they have a 2.5 billion debt outstanding, and they are just not able to fulfill to maintain that facility anymore, and they cannot even pay back the interest for that loan. And that is the trigger point. And that is important because that tells us that actually money, if we view it from the macro lens, money is actually just a game that everyone in the world is playing, because there's no concept of money outside the human race. And this is a game that we all play and we all believe in. But the key here is that we shouldn't focus on how to win in this game of money first, but rather how to make sure we don't lose. And the only way that we don't lose, the only way that we can lose, is when we run out of money, right? And that's even game over. This is like the analogy of, I see it as today we go into the arcade, right? We can top up the card of our arcade, and we can continue to play in the arcade, right? Changing game doesn't matter. We can try different game, but the only time that we will get out of the arcade is when we run out of money, and it's game over for us. We're going home. And so the first thing that we have to focus on in this game of money is to first learn how to stay in the game, how to avoid game over, and not how to win the game first. So some of the key action plan that maybe we can focus on is, again, the most risky part that will bring us to game over is actually our debt. So it's quite common, I think, for most working adults to have some form of debt, be it your car, be it your house, or even your credit card. But that's fine. The starting point is not important. But we have to take stock and understand where is our debt, and what is the interest rate that we're paying, what is the payment that we're paying for each of our debt, what is the outstanding amount that we have with the banks. And from there, we should be able to track our debt outstanding amount, our monthly payment, our interest rate amount, and try to keep that within a reasonable amount, right? Conventional wisdom is try to keep it at least below 30% of your stable income coming in, and to make sure that it doesn't balloon too big. But understanding the interest rate of our debt also give us one more valuable information. That actually becomes our hurdle rate, right? Called our hurdle rate. What is a hurdle rate? This is a rate that we should think of before we make any investment. Because, for example, say, okay, my house, say if my house mortgage rate today is at 6%, it means that I'm paying back the bank a 6% interest every single month. And if I have some excess cash right now, I can think about whether I should invest this amount or whether I should just pay back my loan faster, and I save that 6% interest on whatever I repay back. And that becomes the rate that you think about. So every time you evaluate an investment, you think to yourself, can this investment give me more than 6% potentially, and with high certainty, right? At least a 6% with high certainty. And if that's possible, then it might be wise choice to utilize that money and invest, which is earning more than what I'm paying the bank. But if we can't find that, right, or if we're not willing to take the higher risk to get that more than 6%, say, for example, again, this is from our iFast platform, just our Bond Express, showing some of the key bonds out there. And say if we're looking at bonds that is yielding to us 4 to 5%, then if you have a debt of 6% outstanding, then maybe it doesn't make that much sense to invest in such a bond, right? When you can easily save a guaranteed 6% by just paying down your loan faster. So that gives us a criteria, at least a starting point, a criteria of what am I actually looking for when I invest. And there's a hurdle rate, which is to at least make sure that you earn more than your debt. If not, you just pay back your debt. That's much easier. Okay. So this, I'm sure you guys know who he is, Mark Cuban, very famous billionaire. I think he got much more famous from his reality TV show, Shark Tank, where people would pitch them business idea and then they have to invest as an angel investor. He's also the owner, the key owner of Dallas Mavericks NBA team. So his profile is quite high. But he actually made his fortune from tech. And he sort of created the first online radio or online podcast website. And he sold that to Yahoo in exchange of Yahoo stocks. And then he sold Yahoo stock right at the peak before Yahoo collapsed. Then that's how he made most of his money. And when he make his after he make his millions of dollars, he actually passed some amount to a wealth manager in Goldman Sachs, and he tell the Goldman Sachs advisor, invest this money as if I'm a retiree that requires this money to live, right? Like very, very conservatively, take minimum risk and maintain that amount. And why he does that is actually pretty smart. He does that because to create a safety net for himself. So by creating this portfolio with a third party, with a banker outside, he said that this will be a super conservative portfolio for me. This will be my safety net. And so with the rest of his money, he can actually go out and take on some risks and be an angel investor, be a VC, right? Take some risk and do a second or third or fourth business, because he knows that he's able to take that risk, because the worst come to it, he still have something to fall back on. And that's also similarly to how I think we should start to think about before we invest as well. Because it gave us a peace of mind to start taking some risks in the market. Because the market is really not a place for us to get rich quick. The market is not a place where we can invest in the next 1 or 2 years. We are set for life. Even Warren Buffett, if you look back on his history, right, he has been extremely successful as an investor, but it actually took him 11 years from getting started his first job, about around 11 years before he can call himself a millionaire. Right, think about that. Even Warren Buffett, the best of the best, takes around 11 years to reach a millionaire status. What should be the time frame that we think about, for the rest of us? And if that's the case, right, the stock market can still be a great place for us to build our wealth, but maybe at a much slower rate that we might first anticipate. And so we should have some safety net before we even jump into the arena. So some of the key action plan, which will be to maybe set up a key emergency fund for yourself or your family. And, of course, when you read online, people will talk about have at least a 6 months emergency fund or whatever. But I would say that this decision is up to you. Because at the end of the day, how much safety net that you really need also depends on your circumstances. Be it how much debt that you have, be it how stable actually is your job, right? If you work for a startup, it's not too stable, and maybe you need a little more. But if you have a very, very stable job, say if you're a doctor or you're a government servant, your job stability is much safer, then maybe you don't need such a long period of emergency fund. So this really depends on your own situation. And but the key point is, at least get started. Get started on creating an emergency fund. And what is an emergency fund? Right? Emergency fund is really just a pile of money sitting at a very reputable financial institution that earns you safe interest. You're not going to risk this money at all, and you're not going to use this money in any normal situation. And which is why it's an emergency fund. And we should also, while building up this emergency fund, to make sure that we have other proper insurance plan in place, be it your medical, be it your personal accidents. This will just protect us in the event that something bad happens. And the luck of life is not for anyone to predict. So all we can do is only to protect ourselves on the worst case scenario and to have all this in place. And then after that, once we have all these systems on all these key points that we have done in place, we will be at a much better mindset to start investing, because we will not be too worried of say I need the stock market to do well in order to fund my obligation, or in order as a way out to have more cash for me, because I don't have any cash buffer right now. So with all this, make sure we have all these things set first, and we can go into the investment, the stock market, with a much more moderate mindset and much more stable mindset. And once you jump into this arena, I would want to use an illustration in a sport, say like badminton, right? Or it could be another sports that you prefer, right? But it goes to similar. It can be illustrated for all sports, which is when we look at the sports, professional players will play the sports to win. So they always play it hard and play it very aggressively because they want to win the point. But if you yourself is playing that sports, right, as an amateur or just as a hobbyist, when you play the sports and if you play against your friends, if you notice, how actually do you win most of the point? You don't win most of the point by winning the point, but instead you win the point because your opponent lose it, making errors, throwing the ball out, or unable to catch the ball in time, even though it's a reasonable shot that they can get back. So professional play a game to win, but an amateur should always play not to lose. So that's a very, very key difference on how we should approach it. Because we have, as amateur, right, as an individual investor coming out, we shouldn't really compare ourselves to professional investors, right? They have certain resources that is out of our hands, and we play it as an amateur, as a hobbyist, right, as a part-timer in the stock market. And the key ways that we can make sure that we win in this game is to make sure we don't make huge losses and we don't make unnecessary mistake. Right? If we minimize that mistake and we minimize the losses that we might endure, then in the long run, we will come out on top. Because typically a stock market will appreciate over a long period of time, just because the economy is growing, the businesses inside the stock market is growing as well. And like Benjamin Graham said, the stock market is a weighing machine in the long run, but a voting machine in the short run. So as long as we can stand the test of time in the market and not lose, we will reap the reward of staying in the market long enough. And another key story I want to share with you guys to highlight some of the key things on understanding making wealth and becoming, the process of becoming rich and staying rich is two different skill set to have, right? People who has won the lottery can still end up dead broke after a few years. And when the studies run through them, most of them lost the money by investing in the wrong things. Because not many people will go broke by eating too much, right? Going out and eat too much, or buying too many stuff, buying too many bags, buying too many shoes. Hardly anyone go broke because of that. But many people go broke, especially when they have a windfall, by investing in the wrong things, right? And investing in different the wrong opportunities. And so we have to first make sure that we know how to avoid such pitfalls. And that is to understand actually what it is a reasonable amount that we should expect by investing in the stock market or buying property or asset classes. What is actually the reasonable return that I can expect from them? So that once we have this knowledge, we can not only have a more realistic target, but we can also protect ourselves from scams. Because scam is everywhere right now, especially in the online world. And Warren Buffett just during the AGM last week say that AI scamming is going to be a huge growth industry, where he saw his own video, someone using AI to create his own video with his own voice, promoting like a cryptocurrency scam. So scam will be more and more prevalent, I think, over the next few years or next decade. And we have to learn to protect ourselves. And one of the key ways all this scam works is they would entice us by unrealistic return with minimum effort. And I think once we realize that nothing is really that free and everything requires some form of effort or some kind of time, then we know how to avoid all this scam. Right? And if you see, I just draw down a quick few chart of the rate of return, like the yearly return possible for equities, for some corporate bonds, from real estate, and for gold. And we have here, say, 100-year record of equities. Like if we take back 100 years of equity performance, equity typically return us around 10% a year. 10% a year. Of course, in the last decade, equities has done even better than 10%. So that's a reasonable, I guess, expectation that we can have, that maybe a 10% a year return is actually pretty good. And for bonds, these are not super high grade bonds, but grade B corporate bonds, maybe return around a 7% over a 100-year period. Real estate is around 4%, and gold is around 5%. And if we look at the 50-year record or the 10-year record, it's not too different, except for maybe bonds is much more lower at about 4% over the past 10 years, just because we have been in a very, very low interest rate environment. But apart from that, it's quite similar. So in the range of 5 to 10%, that's typically the return that we're going to get across any asset class. So have that kind of expectation, at least, to protect ourselves and have a more reasonable target of what we can expect when we invest in the stock market. And bear in mind, all this return is not going to come to us linearly, right? It's not going to come to us every year 10%, 10%, 10%, 10%. It could differ drastically over a long period of time. Say, for example, I invested over the past 18 years, around 18 years now. The most my portfolio can rise in a year could be 40, 50% a year. But the most it could drop is also around 40, 50% during the great financial crisis that I went through. And at least in the past 10 years alone, I think I have experienced at least 3 years, I have seen a negative return on my own portfolio, right? So, but if you stretch out over a long period, more or less, you're still getting this 10% return when you're investing in equities. But it doesn't come in a straight line. So we have to prepare ourselves mentally as well for that. So this is just the historical data to back the slide previously. And you're free to download this after that. I'll explain to you how you can download this slide and maybe this database later on. Okay. And another question for us to think about as well is also how should we invest? Because when we listen to other people talking about investing, even myself when I share some of the stocks that I've been researching on or concept that I think should work for me as an investor, I always I would say to you, which is take that just as a reference and come up with a conclusion yourself. Because should we all invest in the same anyway, right? Say if you are a single mother working and having to raise your kid, or if you're a successful businessman, or if you're just, extremely wealthy, you are from an extremely wealthy family. All these the people with different backgrounds, should we all invest in the same manner? Most likely not. So think about what is more suitable for you. What should be your objective or why you want to invest and work your way back from that. And another key realization that I have is that sometimes when we talk about investing, most of us is always focused on, hey, what stock to buy? What stock should I invest in? But at the end of the day, I realized that buying which stock is actually less important. What is more important is actually having the right mindset and the right investing philosophy to think about investment in the first place. And this is explained in a report and an article written by Warren Buffett himself, which is called The Super Investor of Graham and Dodd View, which is he's basically saying that he grew up with a bunch of great investors, all students of Benjamin Graham and David Dodd, which are the author of the security analysis. You can see it as like a Bible of value investing. And he basically say that all these great investors that all are taught by Benjamin Graham and came out to become fund managers, and all has done very well throughout their career. And many times, all of them don't buy the same stock at all. And that's a key insight, which is you can buy vastly different stocks from one another. And somehow, if you have the right mindset and the right foundation, you typically can still do okay in the stock market. So some of the key action plan for us to think about is maybe just find out our objective of why we need to invest in the stock market first, right? Of course, our objective is to make money and make our money grow in the stock market. But I urge you to ask a little bit deeper. What does that money mean to you, right? I recently just saw a short clip where just a psychologist say that they have these people from Silicon Valley doing startup and extremely successful by any standards, right? But are all living in anxiety and very stressed out and unhappy in life. And they go to the psychologist always saying that I'm not a billionaire yet, and I need to be a billionaire. And that they're so fixated with the idea of becoming a billionaire. But the psychologist basically just asked them, yeah, but what does the $1 billion actually do for you? And in a similar manner, I think we can ask ourselves that question, right? We want to grow our wealth. We want to, maybe we even have a specific amount that we're targeting. But what exactly does that amount do to us? Why exactly do we need to reach that point that we desire in the future? It can be just a sense of you just need a sense of security because maybe you grew up in a much poorer condition, and you feel that without money is extremely difficult, and that I understand, and you just need that security. Or you know, you crave approval or the desire to be respected, and you feel that with wealth that will bring you to that destination. So whichever the underlying reason is, I think it's great. It's great. You know, there's no, I would say there's no correct answer. Don't try to even judge yourself, right? But just try to understand much deeper on what's the key reason that you might want to be aggressively building wealth. And then from that, then we can work back. Okay, sure, that's the desire that I want. But what's the time frame? What's the time frame that I have? Be it 10 years, 20 years, 30 years, doesn't matter. And once you have that time frame, work backwards your required return. Okay, so for a simple example, if I want to save $1 million by the end of 10 years, and I'm saving maybe I'm saving just $200 a month. So I save about $2,000, $2,400 a year. So what is the rate of return that I have to do to reach that target? At the top of my head, I don't have that calculation, but it can be easily done, right? Just search IRR calculator online. You can just put in the numbers, how much you're saving a month, what's the end amount, and what is the IRR that you need. And that become your target. And try to make sure that it still fall within that reasonable range. Right? So if you put in and you realize that your IRR needed to reach your target is 50% a year, then maybe that might not be very realistic. You must either maybe reduce the amount that you require in the future, or try and save a little bit more, increase that savings rate to reach that required return, so that it will fall between that magic range that I talk about, a 5, 10, or 15% range is still in the realm of possible to achieve, right? And understand that the stock market is really not a casino, and there's basically different way that we can make money in the stock market, right? There's different strategy that you can use, but most people, when they are investing in the stock market, they treat it like a casino. They're just putting bets and hoping for the best. And to be successful and to have a sustainable process in the stock market, that is something that we have to separate ourselves from the rest. And when you look at what are some of the key strategy out there that could possibly be profitable in the stock market, we have number one, trading, right? We can trade. There are successful traders, and there are very successful funds out there that do trading, yes. But I don't do trading myself, mainly because I feel I don't have an edge if I do it. Even if I have a system that help me or whatever, because the most successful people that is doing trading and making money in the stock market are what we call the quant funds. And the quant funds are using huge computer model, right? They have huge computer algorithm that is running trade for them at milliseconds in the market, and they can use that to their advantage and to generate profit from that trading. And if I'm myself as a one person man, I'm not sure what advantage I really have to compete in that game where people have millions or billions of dollars and huge data scientists and data and software developers to develop model to find profit and arbitrage in the game. So that's one area I don't go in, because I don't feel that I have any key advantage. A second way that when you look across all the professional funds, how they make money is what we have is like a macro fund. These are people like George Soros or people like Ray Dalio that is extremely good at identifying macro trends. And they have made huge billions of dollars from macro trends. Again, I try to avoid that game. Mainly, again, I feel I don't have that huge of an insight to compete in that game. So it ends up that I choose the path of doing fundamental analysis. And when you look at the subset of fundamental analysis, what is the key thing I think we have, even as individual investors, that we have advantage over professional fundamental investors? What is the thing that we have? And I think about this question for quite a long time. And I realized that the key advantage that we have over them is actually time. Because if we have a targeted time frame, say 10 years, 20 years, we know that we have a decade or 2 decades to wait. And we can invest and wait for the amount and wait for the power of compounding to work. Whereas even professional funds out there, even if they say they are fundamental funds, value investing funds, the objective of them is not only to grow the asset, but also to attract new investor. And so they are constantly in that pressure of needing to perform, even in the short term. They cannot afford to have bad quarter or even consecutive bad quarter, and hit the risk of maybe redemption, that investors are going to redeem the funds from them. That's one of their biggest fear. And so they are constantly looking to perform even in the short term. And so sometimes they might make action that is against the philosophy of long-term fundamental investing. And that's where we have an edge over them. I have a short game for you guys, right? I have a short game for you guys. You guys can put it on the chat, or if you just want to put it, write it down on your own phone. I will encourage you to take out your phone or a device if you're using a phone to watch this. Just have a calculator app out. We're gonna play a game of invest or not invest. I'm gonna show you a few slides at different point of this one stock, and you're gonna decide should you invest or not invest, right? And from that decision, and then at the end, let's see what is your performance, and are you do you in a way suitable to be investing in the stock market by yourself? Okay, are you ready? So this is slide number 1. Okay, I take out the year because in a way, if I have the year here, it will give us some tells, because we know that during which year the market is pretty good, or during which year the market is not doing well, then you might have inclination of whether you should buy or sell this stock at the moment, right? But just treat it this one dash line as 1 year. So this is a 1 year period. Okay, and the starting point. Okay, we are at $25. We are at $25, and should you buy or sell this stock? Number 1. Please write down your answer. If you want to play this with us, you can also write the answer down in the chat box. So lock in your answer if you're going to buy or you're not going to buy this stock right now at $25. Okay, and let's go to the next slide. So next slide. Wow, you make 40% in a year. Congratulations to you. Now the stocks, it went all the way up to about 32. It fell back to 25 or below 25. Now it's at 40 within a year. Congratulations, that's a 40%, right? Remember, an average return is 10%. You have outperformed the market by 30%. So what should you do now? this year at 40%. Are you going to sell this stock, or are you going to buy this stock more, or are you going to just hold on to it? What are you going to do? Ready? Lock in your answer. Thanks for answering putting it down. Okay, let's go on to the next one. The next year is still going up. This stock go up another 35%. Now it's at 54. Okay, this is the actual stock price, right? This is not the theoretical. I actually take the stock price from a company, and now the stock price at 54. It almost more than doubled from the beginning. 40% the first year, 35% the second year. Wow, such a bull run for a stock. It seems very hard that it can continue, right? I don't know any stock that can do so well. Are you sure? But maybe this is the one of those ultra fast growing stock. So right now, number 3, would you buy or would you sell or would you hold at 54? Write down, have a mental note. Next one. Oh no, the market has finally corrected. The market corrected. Now this year it has dropped 35%. From 54, it has dropped 35%. Now it's only at 35. It's 35. Wow. That's extremely painful. You know, but what to do? What should we do now at this point? Or, if you have hold on to this stock, you have lost 35%. Should you be buying? Should you be selling and, just give up on this stock? Maybe this stock is one of those stocks that's going to go to zero. Maybe this is the stock price of GameStop, right? Maybe at the end, it's going down to zero. And at this stage, that's where the trouble starts. And actually, you should be exiting now to save yourself. What do you think? Okay, lock in your answer. You're down 35 this year. What about next year? Wow, it has recovered. The stock has recovered 120% since then, and now it's at $77 per share. $77 per share. Wow, what a recovery. What a recovery. Hopefully you guys have bought more during last year. But now you can see that it's at its all-time high. Right, the last time, yes, it's all-time high. That's where we see a 35% decline. Now is at a much, much higher all-time high. What do you think we should be doing right now? Write out your answer. And we have the final one. This stock is actually Apple, and it closed at around 180, I think 182 last week. And from that $77, it has risen again 135%. So why don't you guys tell me, how did you fare in this short game that we have? But I also want to highlight to you that if you have just bought on the beginning at 25 and, disregard whatever I'm trying to taunt you during this game and just hold on to it, right? Because I'm the market noise. I'm trying to mimic the market noise, telling you what's happening. And if you have not been swayed by me and you've just been buy and hold for this stock, the stock has went up 628% for you. How's that? So why are we doing this short little fun exercise, right? The key one is, of course, just to have fun, right? A little bit. But also a little short test for yourself to see that if your temperament is really suited for investing by yourself. Because when we start investing by ourselves, one of the biggest risks that we face and the biggest enemy that we face is actually our own emotions. And very, very often, our own emotion is going to be the one that causes us to make a mistake in the stock market. And so if you just happen to be someone that is uh, more passionate about things, and you have much stronger emotions, then either we can think of uh, ways to try and control and mitigate that, or maybe you come to a conclusion that, DIY investing by myself, maybe it's not for me. Maybe it's not for me. Maybe I should have a different strategy of trying to pick stock in the market. And some of the key ways, I think, very simple one, is to have using like a saving mentality, right? Your regular saving plan, or just dollar cost averaging, and either do it by yourself or have someone to do it for you. And we can invest in simple things like ETF. And I myself is a strong believer of ETF, because the index is already encompassed of some of the greatest company within that index. And so when the index, when a company grows and become better and better, they are doing much, they will be much higher weightage within within the index for us, and hence we'll be much more weighted to all these great companies. But even if the company was not doing that well, they tend to be replaced. So they have a self-replacing cycle, and the company can be replaced with other company coming in. Then maybe that could give them a little bit of boost for the future, and which is why an index over a long time in a growing economy tends to still do pretty well. Okay. And last part I'm going to share with you a little bit is how to create a system around it. And I call it a mini Berkshire system, which I have utilized it myself. This is just one of the examples. Sometimes I talk to my client from in iFast, and I'll share with them, just using a diversified ETF or a diversified strategy, we can build up a quite a safe, generally speaking, and a diversified portfolio towards allocation that we might prefer. Okay, so this is the performance of Berkshire Hathaway, and from the last annual AGM that was just a few weeks ago. So the performance of Berkshire since Buffett took over, if you have just been a Berkshire shareholders and hold on to the stock, it went up about 4.4 million times, 4.1 million%, right? So that is 43,847 times of your investor capital. Whereas at the same time, the S&P 500 actually do pretty well. Over the same period, S&P actually grew 31,000%. So 300 times, 310 times for the S&P. So even investing in the S&P is pretty good. But when you compare, you can see the yellow line is S&P, the blue line is Berkshire. You can see the vast difference of that. And it all comes down to very much, of course, of the wisdom of Buffett and Munger, but also down to the system that they created. You see, Berkshire started out as just a textile company, and when Buffett bought into it, and he bought into it mainly because the company was trading below net cash. So all the cash that he has in the bank, actually more than the market cap, and he has bought into the company. But he actually called it the worst mistake he has ever made, because if he were to create this Berkshire system by himself, he said that he would have made much more money. But what he did is, after he took over the company, he started using the cash to invest in insurance company, and using that insurance company as the base to generate more and more cash flow for him every year to invest more and more and grow and snowball the effect of compounding. So the business of Berkshire today is actually extremely vast. They have, of course, insurance. They have utility. They are one of the biggest utility company in the US. They have railroad. right? One of the only four and the biggest in the US and North America, actually. They have a lot of service and retail companies. They actually one of the largest secondhand automotive chain, and also one of the largest real estate brokerage house out there. And of course, also manufacturing for them. So how does all this system works? And this system works actually when Buffett created it, they all serve a purpose. Right? Berkshire is not structured like a typical company, but they have Buffett in the middle, where he's the main controlling the risk of the company and where the money goes. So the insurance company would generate something called a float, and that float is the premium that people pay for the insurance, and before that they have to pay out, this money is stay with Berkshire, and it's almost like a loan, interest-free loan to them. And so Buffett uses that float to do a few things. They uses the float either to invest in the stock market, and he do it either by himself, his core portfolio, or he do it with sub account, which he has two fund managers working for him, Ted and Todd. Or he use a portion of this fund to make huge acquisition. At the beginning, just family business looking to sell, but the business must be free cash flow positive. So by using all this cash and buying more businesses or buying into great stocks, it brings in more operating income for the company, meaning that he is increasing his income. Right? He's increasing his income significantly by doing all this action. Sometimes the business grow to so big that it become a core business, and all these businesses, any excess cash that they have, they'll pass it back to Buffett, and then Buffett decide where to deploy this money. And using this simple system, he built one of the largest company in the world, right? In the top 10 companies right now in the world, I think 7 of them are tech companies, and Buffett is one of the few there's a non-tech company that has reached the status of a top 10 company. And they call this a Berkshire flywheel, right? Having cash flow coming in with manageable debt, right? The risk management might be very, very strong to ensure the survival. Remember what we talked about right at the beginning of the presentation, right? The first, you must stay in the game. And then from there, you look at how you increase your cash flow and where to invest. Invest in high quality companies, or for Berkshire case, they can buy whole businesses that can generate even more cash flow for them. And then let the money compound. They don't pay a dividend. They let the money grow more and more and let the power of compounding works. So how does that help us? How does that apply to individual investor like ourselves? How do we create our own mini Berkshire? We can do that, right? Because all the component of the flywheel can be scaled down to an individual level as well. Cash flow. Where's the cash flow coming on? Right? Our salary, maybe we have a side income, our businesses that if you own. But the cash flow should be net of expenses, right? The excess saving that we have every month. And we can do that to increase it either by increasing our income or decreasing our expenses. And if every year we try to look for that, have incremental improvement, that our cash flow is improving every single year, that means our flywheel is growing bigger and bigger. And then where to invest, right? For me, at least, like I explained, I feel our only advantage in the stock market is that we can have patience and have a concept of long-term thinking, where everyone else in the market does not have. And if we have that ability and that advantage in the stock market, then we can invest in very, very high quality companies that will do well in the long term. And that allows us to compound that money over the long term at a good rate if the company is well managed. And then we, being at the center of this flywheel, will be in charge of risk management to ensure that we survive, ensure we don't hit game over, That means ensuring that number one, we have excess cash flow, and number two, also to ensure that our debt is manageable. And just by doing just these few simple actions, and then not disturbing the power of compounding, by maybe timing the market. And once we try and time the market, maybe we'll end up disturbing the power of compounding over time, right? Because in the previous example that we run through, just a little exercise that we run through, I only give 5 steps, 5 points in the stock's life that we have to make a decision. But if we're investing in actual fact, we will be bombarded by this distraction and this noise, this market noise and market fear or market greed every single year, every single day that the market is open, right? So if you explanate, if you extend the noise that I'm making to you during the 5 key moments into every single day across, maybe you have 20 stocks, and that is the amount of distraction that will be coming to us if we choose to create our own portfolio. And if we can resist that, not be affected by that, and truly let compounding work their magic over time. So this is a small summary of how we can create our own mini Berkshire flywheel. So I talk a lot about this and more actually in my premium club for our members, and I go into much more detail, sometimes looking at different ETF and portfolio construction. That's my goal, I feel, to help people understand this system that I have used for myself, of course taught by Buffett, and how I have utilized it and to good effect, at least in my own case, and I hope to share it with my members as well. Okay, so thank you so much for your time today. If you have any question, feel free to ask me on the chat box. And if you want to download this presentation and also have a written summary of what we discussed, remember to join my mailing list, where you will get you'll get the download link by tomorrow, and also some added resources that I found that will be useful for you, that I'll download into a shared folder and I'll email to you guys tomorrow. So remember to join my mailing list just by going to Learn with Stanley. At the bottom of the page, there will be a join my mailing list, and or you can just scan the QR code right here. And I hope you join us. You get the updates on our future webinars that we're gonna be doing, and also any added resources that we talk about during this presentation. I'll email out to you guys by tomorrow evening. So yeah, if you have any question, I'd love to take them. And if you want to reach out to me, just have a chat. This is my email, my iFast email, or just go to Learn with Stanley also, or learnwithstanley.com. All my official channel and social media account that I manage myself will be on there, right? There are instances where I found out that there have been scammers, especially on Facebook, on Telegram, that's using my photos and my name and Value Invest Asia to promote scams as well. So just be careful, right? Every time, I would not go out and message you on purpose. So if someone that has my picture and approach you, just assume that that's a scam. Or ask for, and every time you want to reach out to me officially, just go to Learn with Stanley, and all my official channel will be there. Okay. And before I take the question, I just want to share one key quote to you guys before we leave, which is from Mark Twain, where this is one of the best quote that I love, which is: risk comes from not the things that we don't know, but rather it comes from the things that we know for sure that just isn't so, right? Think about that for a moment. I'll repeat that. Risk come not from the things that we do not know, but rather from the things we know for sure that just isn't so. And I love that quote, right? And it reminds me that in investing, always keep my ego in check. Right? and to make sure that I don't go too overconfident in everything that I do in the stock market. So I leave it with you. And let's take some questions. Thank you very much. Hi, I'll read out the questions from Zoom first. And CWS, thank you for joining us this evening. And you said that, hi, Stanley, I understand that any non-performing stock of the ETF will be replaced, but what are the risks of investing in ETF? Okay, so this is a rather broad question because it depends on what ETF you invest in. And ETF, it is all different, many kinds, synthetic ones where they don't really invest in the stocks. But for the sake of this question, let's just stick with passive, well-known passive stock index ETF. You know, your S&P, maybe your Hang Seng Index, your Straits Times Index, your KLCI Index. So some of the key risks is because they are passively managed, right? If we look at just passively managed ETF, they don't have the risk of, say, the share fund managers leaving, right? Because they're just tracking the things. Some of the risk is, of course, the country risk itself. So if the country economy fell into hard times, then most likely that index will suffer as well. As a ETF itself is also just a fund, so you can think of it as like a unit trust, but just listed unit trust. And they are originated by some fund companies, be it iShares, be it BlackRock, be it Vanguard. So these are also fund companies, and we're also taking on to the risk that that company could fall into trouble. Like, we never know, right? So these are some of the key risks that we have to take as well. But apart from that, I would say, just your usual market risks are very, very similar to how you would invest in a unit trust. I think the risk profile is relatively similar. And how we can go about maybe mitigating that a little bit is try to look for more well-known names and also much bigger size ETF. And because some of the smaller size ETF, they might risk the potential that they could be delisted or they could be closed down if they just don't have enough scale. Because ETF generally tend to have much, much lower management fee and costs associated with it, right? So they need a much bigger scale to be sustainable. Unit trust maybe charging a 2% annual management fee could be sustainable, say at a 100 million mark. But ETF maybe charging a 0.2% annual fee. That basically they need to be $1 billion before they reach a sustainable level. So that's something to think about. Thank you so much. Thanks for share. Dave said, thanks for sharing. Yep. Thank you, Dave. I'm so glad that you are able to join us this evening. Next question coming from Chan, saying that did you feel confident after you walk away from Berkshire annual meeting about the post-warrant future? Yes. So, okay. So I still own Berkshire Hathaway as disclosure. I've owned it for quite a long time, and it's a very it's a very sad moment that this year that there's no Charlie, right? The first time there's no Charlie in the annual meeting. And Buffett also joked about that, he hoped that we can join him next year and he can join the AGM next year as well. But I think generally I'm still very confident of Berkshire future, at least for the next decade or so. Because more or less he has laid out his plan of what's going to happen when he leaves. The board of directors, including two of his children, will be the trustee that is making sure the culture and system of Berkshire stays the same. The small portfolio will be handled by Ted and Todd. All the big investment decision will be handled by Greg. And Ajit will continue to run the insurance business, but Ajit also said that he has already identified his successor over there. So the flywheel of Berkshire would still relatively stay the same. But I think the rate of return that we can expect from Berkshire maybe wouldn't be as great, because even after the past 10 years, they're growing like 20% a year for us. I think, but they are already such a big size, close to a trillion dollars of company. I'm not sure that they can continue to grow at 20% rate over the long period of time. But to beat the market, I'm actually still quite confident, but just maybe not at the margin I expect, from the last 10 years. Hopefully that answer your questions. Yeah. Thank you very much. Let me see if I can see you guys. Okay. Yep. I hope if you guys have any question, you can always reach out to me. But thank you so much for sharing your evening with me. I truly enjoyed this presentation with you guys, and I hope you give some thought of what we have discussed today. And till we meet again, invest safely, guys.